Hi, I'm Tom Lydon, editor of ETF Trends here in Chicago at the Morningstar ETF Conference. And I'm here with Luciano Siracusano, who's the Chief Investment Strategist at WisdomTree. Luch, great to see you.
Good to see you, Tom.
And I know you just had a panel on currency hedging, but it really just brings up the question, are currencies really an asset class that advisors need to pay attention to these days?
Well, currencies are certainly a source of risk. I don't think they're necessarily a source of return over long holding periods. Now, this is not to say there aren't 3, 4, 5-year periods where currencies can move in one direction or another. The real question is if it makes sense over a 10, 15, 20-year period, particularly in the developed world. And the evidence that we've seen basically says no, that you're not being compensated for the risk you're taking, for the added volatility that having those currency exposure in your portfolio creates for you.
Over the past 10 years or so, as the dollar had been declining, there really wasn't much of a need to be concerned about currencies. But over the last couple of years, as we've seen the U.S. get closer and closer to rising rates, and all the monetary easing that's been kicked up in the developed countries, there surely has been some movement. And you folks are really providing opportunities to hedge away from that type of risk.
Exactly. I mean, over the last year, the dollar's appreciated about 12% against a basket of foreign currencies. The euro's down double digit, the yen is down double digit. This year, many emerging currencies are down in the emerging world. And people are saying, to the point of, do I want to have my equity gains washed away by losses on the currencies? Yeah. Is there a reason for me to be 100% unhedged? And our argument is if you don't have a view on where currencies are going forward, you shouldn't be 100% unhedged. Yeah. We actually think at the worst case, you probably should be 50-50. But there's a strong argument that you should separate the currency bet. Only make the active bet to be long the foreign currency when you do have a view about which way things might be headed. So we think for a variety of reasons, it just makes sense to make them two separate decisions. And we think we give you a lot of tools that help you do that.
So in reality, if you don't hedge out the currency, you actually do have a bet on where the currency's going, is that right?
Yeah, you're basically making a bet that the dollar will continue to weaken against all the foreign currencies in the world, even though the dollar strengthened like 35% over the last 4 years. And when the dollar is in a bull market like it is now, these bull markets can stretch 5, 6, 7 years. There's a great bull market in the dollar in the 80s, a great one in the 90s, and we may have a few years left on the current one.
Yeah, we're just, and maybe in the early stages, but just to give some type of frame of reference, when it goes 7 years or so, percentage-wise over those periods, how much did the dollar appreciate compared to global currencies?
Well, in the 1980s under Reagan, the dollar went from had about a 50% appreciation from low to high against the basket. Under Clinton, it was about 35%. We're already in that 30 to 35% range, but we still have a few more years potentially of money printing around the world. And if the Fed starts to raise rates in 2016 and gets to where the market thinks they'll get to by 2017, that could create another driver for dollar strength going forward.
So WisdomTree has a whole basket of tools that addresses currency hedging in developed countries and emerging markets. Maybe just briefly run through the way you look at this suite.
Yeah. Well, we have it country by country where those countries typically benefit from a decline in currency. Yeah. Japan, Europe, very good historically for their equity markets. Recently, we launched a world ex-US solution, which is typically 85% developed, 15% emerging markets, where we hedge out all of those foreign currencies. And that costs us maybe 50 to 60 basis points a year to do. But that's very important for an advisor who wants to hedge out currency risk in emerging markets. That's a way to do it. And if you're allocated along those ratios, you can add to what you already own with just one ETF to help bring down the currency exposure in emerging markets without paying 4 or 5% to do it directly.
Absolutely, that's great. Luch, as always, I learn something every time. Great seeing you.
Well, it's always good to talk to you, Tom. Thank you.
Thank you.
Ciao.